the just confusing labor market. We would expect that to not be where it is today. What goes on here?
Yeah, still record level of job openings that are not getting filled. Labor shortages are rolling through the economy and creating disruption in a lot of different industries and businesses. And if you look at how the Fed has changed their tone, shortening the taper, getting that done more quickly and aggressively, potentially raising interest rates quicker than they previously signaled, they might be concerned about inflation running hot for an extended period because of how tight the labor market is, because of something like a wage price spiral, which is something we haven't seen in this country since the 70s and 80s. So very interesting to look at that data and see if there actually is potential for that. So this chart, this fits very much into how we're thinking about inflation, is that the probability of inflation overshoots over the next 5 years is rising. Not going to make a bet on what CPI is going to be, but if there are going to be surprises, they're probably going to be on the upside because of all these sticky issues related to supply chains and commodities, and then also the labor market, most importantly. So we're seeing this in financial markets. So this blue line is the implied probability of the CPI running above 3% for the next 5 years. How do you come up with this number? Well, there's a financial instrument called a CPI cap, which is basically like an insurance contract you can buy, and it gets paid out if over the next 5 years the CPI is above 3%. And from that, the price of this security changes all the time with the market. And so you can deduce from the price of this insurance contract what the implied probability is that inflation is going to run hot. Very interesting chart to look at, because you go from starting 2014 when we had the oil price collapse. OPEC couldn't agree to cut production, and we were producing a bunch of shale oil. From there on, nobody really bought this thing because nobody was really worried about inflation running over 3%. We were in a chronic disinflation, inflation undershoot type of an environment. Then COVID happened. Then really nobody was buying this thing. And then the COVID recovery happened. And the price of this, the probability of inflation running hot, shot up until we got our first look at that big transitory CPI print. So the April 2021 print. That's when we were at the peak, because everybody was fearing the worst. And then you looked under the hood at where the inflation was coming from, and you're like, used cars, hotels and motels, airlines, like this is not going to last forever. This will not last 5 years. This is transitory. And then these things sold off. But now it's coming back up. So once again, the probability of inflation running hot over the next 5 years is about 40%. And we know now this isn't about transitory or not. There's something else here that is stickier that people are worrying about. And the likely culprit is wages. And what we're seeing in the idea of a wage price spiral, or a second order impact of inflation, where wages keep rising and then companies keep needing to raise prices because they're paying out more in wages. And so this thing feeds on itself, and it lasts for a very long time.
Yeah, there's a lot in here. I mean, energy prices, rents, all that stuff. It's all sort of culminating in this persistent sort of rise in this measure, which is a great measure. Let's sort of balance that against the idea of these job openings, because wouldn't we be seeing fewer fewer people or more people going to work with these wages rising? Like why aren't we seeing this gap close on this next chart?
Yeah, great question. So the first thing you have to do is, and we've showed this chart before, what it shows is that right now there are 10.9 million job openings, which is a record. That's the green line, versus 8.4 million unemployed people. So there are only 0.77 unemployed people per job opening. So it is a job seekers market. And why isn't this starting to rectify itself? Especially because, expanded unemployment benefits have expired in all states across the union. So now people should be getting back to work, right? And the first thing you can do is you can just question the green line. Because theoretically, I could create 1 million job openings tomorrow. I could just, obviously that sounds ridiculous, and the concern would be you would actually fill those. But you can create job openings all you want. And in an environment where you're putting out more and more openings and they're not getting filled and you're getting more and more frustrated, it might incentivize businesses to put out more and more postings. Knowing that you're going to get a 10% hit rate. I need 2 people. I'm only going to get a 10% hit rate. Well, now I need to put out way more openings than if I was getting a 50% hit rate, right? So this can sort of feed on itself in that way. So that's one thing. You could question the green line. The other thing, the other thing you look at is sort of the regional aspect of this, or the geographic mismatch effect. So there are a number of states in the country that really haven't had a tremendous amount of restrictions on mobility throughout COVID, and a lot of people moved there and brought their demand for labor with them, but labor didn't move there. Labor stayed where it was at. And so you have this big geographic mismatch where there are all these job openings in places like Idaho and Oklahoma and so on and so forth. But it's not like everybody who worked downtown Chicago is going to move to Oklahoma to fill that need. So there are a number, and then there's also declining labor force participation, which we can talk about.
Yeah. Yeah, all big factors here in a area where you really, and you get these large announcements from companies. Even today, I think Target announced they're going to hire 35,000 people for the holiday season. It's like, where are they going to get these people from?
Yeah, right. Yeah, it's a big problem.
Yeah.
Yeah.
So let's pull up the next chart and look at the wage growth cycle here.
Yeah, we know, as you were saying, wages now are rising because companies are competing for labor, on a level that we haven't seen in quite some time. So offering higher wages, signing bonuses, and so on and so forth. And the wage gains are primarily coming from low skilled jobs, which, isn't a term that we necessarily like, but that's the economic term for it.
Yeah.
And folks in the 16 to 24-year-old age range, which folks in 16 to 24 usually have the highest wage growth. That's because they're coming off of such a low base. But what you see is after every economic recession, it takes longer and longer to get back to something close to the pre-recession peak, and you don't even get there. So this time is way different. After COVID, we're basically already back to pre-COVID levels of wage growth in these two areas in only 19 months. And taking into account that the pre-COVID labor market environment was one of the tightest we had ever seen. So we're already back. So, you take this and you think, well, should the Fed be worried about this? And based on what they're saying and what they're now doing when revising the taper timeline and interest rate hike timeline, you think they probably are. They're worried that they're late because every other time you get wage growth in these areas at these levels, the Fed is already hiking. In 2007, 2006, they're hiking at every meeting. In 2015, 2016, they're kicking off a hiking cycle. And they're still buying 120 billion in assets. They're not even close to hiking yet. So they might feel like they're a little behind because they don't want to let a wage price spiral happen because that creates misery, and that's a problem for them.
Right. And how do you think companies are dealing with this labor shortage right now? Are they viewing this as a long-term issue, or is this just a temporary thing as they retool their productivity to be less dependent on actual physical labor?
Yeah, great question. So everybody wants to know how long this is going to persist because that's going to impact how they invest, right? But we know, especially coming into the holiday season, if there's a big surge in spending on services, and a lot that could be the exact catalyst that companies need to become less dependent on wages, on labor. Find new creative ways to keep the restaurant open at full capacity with fewer people working. Automation, technology. Also, if you think about the areas that of the market where it's hardest to find employees, so low skilled jobs, 16 to 24-year-olds, those sort of have the fewest barriers to entry, if you will. Technically, there's a very high substitution rate of labor in these areas because they don't require advanced college degrees and things like that. So there's that idea too. I mean, eventually, if you raise wages enough, hopefully these jobs will be filled, and these are should be some of the easiest jobs to fill. So there's totally potential that in 12 to 24 months this is resolved,
Mhm.
and we could be on the cusp of raising wages to a level that attract more people. But it's just tough to say.
Yeah. And at what level of wage increases do we pull people pull people back into the labor force because the participation rate is so low, or pull them out of retirement because they retired from COVID?
Yeah. So if you look at the labor force participation rate, so if we can actually go forward like 2 slides, this I think is very interesting
Mhm.
to speak to your point. So the labor force participation rate is in green. We know it's very low. It's low because people aren't looking for jobs or they're retiring. Baby boomers are retiring dramatically. But typically you see labor force participation start to go up towards the end of economic cycles. That's also when you see wage growth start to go up towards the end of economic cycles. So it's totally possible that we're early in the economic cycle, but we're getting wage growth like we would at the end of the economic cycle. And therefore, labor force participation comes back quicker than in previous cycles. That case can certainly be made. The other factor is what would have to happen to get baby boomers to come out of retirement? You would probably need an equity market drawdown because all their retirement accounts are in great shape. So unfortunately, you would need that, and we don't really see a huge equity market drawdown in the cards in the next 12 months at least.
Mhm.
So tough to say, but you can definitely make a case that this could get resolved quicker than in past cycles.